Silver didn't just move, it reacted. And when a market reacts this violently, you have to ask a serious question: did something fundamentally break, or did the structure simply reset? Over the past few sessions, we've seen sharp spikes, aggressive pullbacks, margin changes, delivery chatter, and headlines screaming about shortages and exchange stress. But volatility alone doesn't equal collapse. Sometimes the most dramatic moves come from mechanical pressure, not structural failure. If you want to understand what actually changed in silver and whether this is risk or opportunity, you need to look beyond the noise and into the plumbing of the market. One of the most misunderstood drivers behind the recent silver drop wasn't a hidden shortage, a geopolitical shock, or a sudden collapse in demand. It was margin mechanics. And that may not sound exciting, but in leveraged markets it is everything. When volatility spikes, exchanges respond by raising margin requirements to protect clearinghouses from counterparty risk. That change forces traders to post more capital to maintain the same position size. Here's the critical part: nothing about their thesis has to change. The fundamentals can remain intact. But the cost of holding exposure rises overnight. In futures markets, participants are not paying full value for the metal. They're posting a performance bond. When that bond increases, leverage effectively shrinks. A position that felt manageable at yesterday's margin suddenly becomes oversized relative to available capital. Traders then face a decision: wire more cash immediately or reduce exposure. Many reduce. That reduction isn't emotional, it's mechanical. And when multiple leverage participants act simultaneously, selling pressure compounds rapidly. This is why sharp declines during volatility spikes can look like systemic failure when they're actually leverage compression. Risk managers at funds tighten exposure limits. Brokers increase collateral requirements. Systematic strategies rebalance. The result is forced liquidation layered on top of thinner liquidity conditions. Price moves accelerate not because conviction disappeared, but because balance sheets tightened. Understanding this distinction matters. A leverage-driven flush is structurally different from a fundamental breakdown in physical supply or demand. One reflects capital constraints. The other reflects structural imbalance. When margin hikes trigger liquidation, price action can overshoot in both directions. Recognizing when a move is mechanical rather than fundamental is what separates reactive trading from disciplined analysis. There's a number circulating that sounds alarming at first glance. Open interest in silver futures represents hundreds of millions of ounces, while the registered inventory inside the Comex vault system is far smaller. The leap many make is immediate and dramatic. If everyone stands for delivery, the exchange won't have enough metal. But that assumption misunderstands what open interest actually represents. Open interest is not a line of investors waiting for trucks to back up to a warehouse. It is simply the total number of outstanding futures contracts that have not yet been closed or offset. Futures markets exist primarily for hedging and price discovery. A producer may be short contracts to lock in selling prices. A manufacturer may be long to secure future supply. Funds may be running spread trades between months. Systematic traders may be holding positions they intend to roll before expiry. The vast majority of contracts are closed or rolled forward well before delivery becomes relevant. Historically, only a small percentage of total open interest ever converts into physical settlement. What actually signals stress in a futures-backed physical market isn't a large open interest number. It's persistent structural pressure. Are total warehouse inventories declining consistently? Are we seeing sustained backwardation where near-term contracts trade at a premium to later months? Are spreads widening abnormally? Are lease rates tightening? Those are tangible signals of strain. A single snapshot comparison between open interest and registered inventory lacks context because it ignores turnover, rolling behavior, and hedging mechanics. Markets operate on flows, not static numbers. Contracts open and close daily. Positions shift between participants. Delivery intentions evolve as price changes. When observers treat open interest as guaranteed physical demand, they convert a risk management tool into a crisis narrative. Serious analysis requires tracking patterns over time, not reacting to one large figure detached from how futures markets are designed to function. When people look at warehouse reports from the Comex, they often focus on one column, registered silver. If that number declines, the immediate reaction is alarm. The assumption is simple. Less registered metal must mean less available metal. But that interpretation skips over how inventory classifications actually work and why they can change without a single ounce leaving the building. Registered silver is metal that has been specifically warranted and designated as deliverable against a futures contract. Eligible silver, on the other hand, meets exchange specifications and sits in approved vaults, but it has not been assigned a delivery warrant. The difference is about designation and intent, not purity or location. The bars can remain in the exact same vault, in the exact same physical position, and move between categories through administrative action. Here's where nuance matters. Owners of eligible metal can choose to register it if they want to make it deliverable. Likewise, registered metal can be deregistered if the owner no longer wishes to keep it available for delivery. These shifts are sometimes strategic responses to spreads, financing conditions, or expected demand. They do not automatically signal that silver is exiting the system. Real structural stress shows up differently. It appears as persistent declines in total combined inventory, not just movement between categories. It shows up when withdrawals continue week after week and are not offset by new deposits. It becomes more convincing when paired with tightening spreads, unusual premiums for immediate delivery, or financing strain. Warehouse data is useful, but only when interpreted in context. A headline that highlights falling registered stocks without examining eligible levels or total inventory trends can create a distorted narrative. Serious financial analysis requires tracking the full balance sheet of the vault system over time, not reacting to one shifting classification in isolation. When headlines highlight elevated silver premiums in China, the narrative often jumps straight to shortage. The logic sounds convincing. If buyers in one of the world's largest physical markets are paying significantly above international spot prices, supply must be constrained. But before accepting that conclusion, it's critical to ask a more disciplined question. What exactly is that premium measuring? A premium is not just a reflection of scarcity. It can also embed currency dynamics. Import duties, value-added taxes, financing costs, local liquidity conditions, and contract specification differences. If capital controls tighten, if export licensing slows, or if regulatory approvals take longer than usual, metal can become temporarily more expensive in one jurisdiction, even when global supply remains adequate. That friction creates a regional dislocation, not necessarily a worldwide depletion. China plays a central role in refining and trade flows for precious and industrial metals. Adjustments to export licensing rules or shipping approvals can slow the movement of refined silver without reducing global mine output. That slowdown matters because metals markets function on timing. Industrial buyers do not need metal next quarter, they need it on schedule. If flows become less flexible, premiums rise to ration short-term availability. It's also important to distinguish between sustained structural tightness and episodic pricing gaps. A temporary premium spike may reflect logistical bottlenecks or financing shifts. A persistent, expanding premium over multiple reporting cycles would carry more weight. Markets respond to marginal supply constraints, not just aggregate reserves in the ground. Elevated Chinese premiums deserve attention because they can signal friction in the supply chain. But disciplined analysis requires separating structural shortage from policy-driven or financial dislocation. Not every premium is proof of depletion. Sometimes it is evidence of plumbing stress in a complex global trade system. One of the most overlooked realities in the silver market is that supply does not respond to price the way many investors assume. When prices surge, the common reaction is to say producers will just mine more. That logic works in theory for commodities where output decisions are directly tied to that commodity's price. Silver is different. A substantial portion of global silver production comes as a byproduct of mining copper, zinc, lead, and other base metals. That means silver supply is often a secondary outcome, not the primary objective. If copper demand weakens or base metal producers reduce output due to macroeconomic slowdowns, silver supply can tighten even if silver prices are rising. Mining companies make capital allocation decisions based on the economics of their primary metal. Silver revenue, in many cases, is supplemental. So when people expect an immediate supply response to higher silver prices, they're assuming a flexibility that doesn't structurally exist in the short term. There's also a time dimension that matters. Even when a company decides to expand production, permitting, financing, exploration, development, and processing capacity adjustments take years, not months. Mining is capital-intensive, regulatory-heavy, and operationally complex. The idea that supply can be dialed up quickly ignores these constraints. Add refining capacity, transportation logistics, and trade policy to the equation, and the system becomes even less elastic. Silver must move through multiple stages before it becomes usable for industrial or investment demand. Any disruption in those stages, whether from policy, labor, or infrastructure constraints, can tighten availability temporarily. In markets where supply is structurally rigid in the short run, price volatility increases. Small imbalances between marginal supply and marginal demand can produce outsized price reactions. Understanding silver's byproduct nature is essential to interpreting why tightness can emerge even when there is no dramatic collapse in global production headlines. Silver occupies a unique position in global markets because it sits at the intersection of two powerful forces: industrial necessity and macroeconomic hedging. That dual identity is what makes its price behavior more volatile and often more misunderstood than gold. When investors look at silver purely as a monetary metal, they miss half the equation. When they focus only on industrial demand, they ignore its sensitivity to capital flows and macro risk. On the industrial side, silver is embedded in electrification trends that are accelerating. It plays a role in solar panels, advanced electronics, grid infrastructure, and data center hardware. As electricity demand rises and digital infrastructure expands, the requirement for conductive and reliable materials increases alongside it. Industrial demand in these sectors is not speculative, it is functional. Manufacturers can optimize and reduce usage per unit over time, but if total production volumes rise faster than thrift efforts, aggregate demand can still expand. At the same time, macroeconomic conditions are shaping investor behavior. Elevated sovereign debt levels, shifting central bank reserve allocations, and persistent fiscal deficits contribute to demand for tangible reserve assets. While gold remains the primary reserve metal, silver often benefits indirectly when investment flows move into the precious metals complex. Because silver's market is smaller and more thinly traded relative to gold, incremental capital flows can generate disproportionately larger price swings. This creates a feedback dynamic. Industrial users pull from the physical market for operational needs. Investors allocate capital based on macro hedging considerations. When both flows occur simultaneously, available supply tightens more quickly than participants anticipate. Conversely, when leverage unwinds on the paper side, silver can fall sharply even if industrial demand remains stable. Understanding silver requires monitoring both lanes at once, the real economy's material requirements and the financial system's capital positioning, because volatility often emerges when those forces align rather than move independently. Markets reward clarity, not emotion. Silver's recent move wasn't a mystery. It was leverage adjusting, narratives accelerating, and supply dynamics colliding with positioning. The real edge doesn't come from reacting to headlines. It comes from understanding structure, tracking data, and separating mechanical selling from fundamental change. Stay analytical. Stay disciplined. Because in markets like silver, the difference between panic and preparation is what ultimately defines performance.